Thanks for tuning in to Alpha Mughals, a show where we speak to some of the finest investing minds to try and figure out how are they feeling about the current investing climate and how is it that they aim to generate alpha in their portfolios or rather their investors' portfolios. Our guest today is Ravi Dharamshi of ValueQuest Investment Advisors. Ravi, good having you. Thanks so much for joining in. It's almost been a year, Ravi. The last time that you were with us, you made a bit of you're a bit of a soothsayer. You mentioned that there was an absence of volatility in 2017 thus far then, and 2018 will see a return of volatility in a meaningful way, and that did come about, and boy, it's brought about a bit of a halchal in the stock prices.
Yeah. Thank you, Neeraj, for having me on the show, and warm wishes and happy festivities to you and your
Thank you.
viewers. Yeah, coming back to the question of volatility, I mean, it looked like an obvious thing at that point of time, and some of the things were not so clear, but in hindsight, if I were to just paint you the picture back again, we've had 9 years of bull market in US. We've had the US 10-year rate going from 1.6 to 3.2. Crude had shot up to 85. Bond yields in India went from 6.4 to 8.23. So there was ample reason for the market to, at best, pause. But obviously, what the action panned out has shaken the confidence of the best of the investors. So yeah, I mean, in that backdrop, it seemed like a foregone conclusion that volatility is going to come back. Now the question really in our mind is whether the top that has been made recently, is that a top for 6 months, 12 months, or is it something more prolonged and elongated that we need to question?
What's your gut?
No, so if I were to just list down the reasons, the macros were really bad. Combined with that, the valuations in some pockets were really expensive. So there was a very, very legitimate reason for the markets to pause. But there were a couple of things that were missing as well. Like, I think euphoria, I would say, was missing. Okay, there has been a lot of inflows from retail into the mutual funds, but I wouldn't classify that as euphoria. And the leverage cycle in India is yet to begin. I mean, we are still deleveraging our balance sheet. So those are the reasons why I feel that that is more like a 3, 6, 9 months kind of a correction rather than a 12, 18, 24 months kind of a correction. And more, or it's restricted probably to a pocket where the valuations got a little more expensive, like consumers and maybe NBFCs. Those are that's how I would look at it.
Okay, interesting. One more thing that you had mentioned then, and at that point of time, not too many people were seeing this, but you had mentioned that due to global factors or local factors, there'll be a drawdown that will happen in 2018. It has happened. And the probability of a drawdown and a sharp one were very high then. Here on, for the next 12 to 14 odd months, as the case may be, is the probability of a sharp drawdown more, or do you reckon that a large portion of a valuation drawdown has happened for India, and the probabilities of we actually doing better are more pronounced?
No, so I fall in the camp that believes that large part of the drawdown is done. But that doesn't mean that we are going to start having a wealth creation cycle again soon, because there are still some events lined up. And okay, maybe we took care, we are lucky that some of the macros have fallen in place for us. The crude has dropped dramatically, which is leading to stabilization in the rupee and the bond yields. So that is out of the way. Thankfully, that should provide some kind of a flow to the market. At the same time, there is uncertainty on the US-China trade war. There is some uncertainty. Actually, we are globally still in the liquidity is still in a receding mode because US economy is strong, and maybe even to some extent Europe is also recovering. So incrementally the liquidity is receding. If in that kind of a scenario, we cannot be making a new high. So I would say that going forward for maybe next 6 to 12 months, we are more likely to be on neutral grounds. There will be ups and downs, and we have to take advantage of that volatility rather than a clear trend suggesting that, okay, we are done falling, we'll make a new high. I don't think so. Or we are, the top is in place and we'll fall another 20%. If both the scenarios right now look like an outlier to me.
Interesting. A very avid bottom-up stock picker is talking about market cycles. The Howard Marks book had some influence?
Oh, yeah. Yeah, you know what? We we are so focused on the companies that we are invested in that sometimes we miss the slightly bigger picture, and that hits us hard every few years. And 2018 was definitely one such scenario where macros came in and out of the blue we had a sharp correction. For what happened in September, October, I don't think even the the most bearish of the guy would have anticipated this kind of a drawdown in a couple of months. And in the couple of months, only the large caps have corrected. Actually, the mid caps had been correcting since the beginning of the year. So on the top of a 30% kind of a fall, another 30% kind of fall, 30-40% kind of fall in mid caps, and that really, really hurt a lot of investors.
Interesting. So, Ravi, what happens then? I mean, how does an individual investor for himself, or how does a portfolio manager who's managing other people's money in such a market wherein, for lack of a better word, we may have a lull? How does one generate wealth then? Is it very, very bottom up right now? I mean, would there be absence of themes but specific pockets within those themes which would be winners? How do you create a portfolio now?
Right. So before we move to the stock picking part of it, I would just say behaviorally, one needs to mentally adjust to being okay with subpar returns for a period of time.
Okay.
See, you cannot time the market precisely. Okay, I'm going to sell here and I'm going to buy here. So if at this juncture, I mean, again, going back to what Mastering the Market Cycles by Howard Marks, essentially you have to be in neutral mode at this point of time. The book talks about basically you have to understand where you are in the cycle. And by cycle, I mean it could be a market cycle or an economic cycle or a leverage cycle. So if you are aware where you are in the cycle, and then you have to adjust your behavior to that portion of the cycle. And today where we are, I think we should be in a neutral zone rather than being very aggressive or very conservative. There were some concerns about overvaluation, and I think the 2 months of market correction took care of that. So again, we are probably at the neutral range. So now that is the behavior on how to, should I be allocating more to the equities? Surely, if your percentage allocation is not too high, then you should be thinking of allocating. But at the same time, it is not a rising tide. It is not like every company or every stock is going to do well. It will be a very nuanced market. It will be a very stock pickers market. It will be a very volatile market. And you will need all the patience, conviction, and courage that you can gather to hold on to what you have. So the point number one for creating wealth is to stay invested in equities through this volatility. If maybe, of course, some amount of pruning, some amount of getting out of stocks that you believe are deadwood in your portfolio and getting into something where the new themes are emerging, that should be broadly the strategy, in my opinion.
Trying to talk about some specifics, Ravi. It's been an unusual somewhat of sorts, and I call it unusual for a couple of reasons. One, volatility made a comeback, and usually in volatile times, you would see a flight to safety of sorts. Maybe we saw that in IT, but there were probably idiosyncratic reasons for that as well. There was no HDFC Bank, there was no Kotak Bank, there was no Maruti in the list of the top 10 gainers. In fact, we had those ICICI banks, Axis banks of the world, which typically, in that sense, volatile stocks, more not the anchor stocks for portfolios doing really well. How do you think the next 12 months could be like from that perspective?
So again, going back to the point that I made earlier, what preceded this volatility was that the index or the market performance was carried on the shoulders of few stocks, very, very few stocks, the levers, HDFC banks, and Marutis of the world. So market was actually positioned in those defensives before the volatility started. So they could not be the safe haven that one usually looks out for. And on the other hand, the other banks that you mentioned where there was severe underexposure over there, and that is why those are the ones where the money is actually flowing into that, and they are providing the returns rather than. So I think the one thing that we can be sure of is that the nature of the market is going to change.
Can you explain? Yeah.
Yeah. So I think, as I mentioned earlier, the consumer and the NBFCs, which were the darlings of the market till maybe 3 months back, were priced for perfection, and definitely there is going to be a growth slowdown over there. Both are intertwined with each other to that extent, and that growth slowdown will reflect in the coming period. So I think there is going to be a 1 to 2 year period where these sectors are likely to not provide great returns. I'm not sure on absolute basis, but for sure on a relative basis, they are not going to do well. So if that is the case, then the mantle needs to be picked up by something else. So there was a time 12 months back that the expensive stocks kept getting expensive and the cheap kept getting cheaper. So the expensive stocks have now started correcting, but the cheap are not yet so back into the upcycle mode. So I believe, for example, cap goods is one space where I think the profit pool has shrunk dramatically over the last decade, and it provides for a happy hunting ground. I think if private capex cycle picks up, and there's a good probability of that happening over the next 12 months, then there will be a good winners coming out of this. I think that's a sector that market has ignored for a long period of time.
Interesting. I'm being accused on social media of meeting a guest and then straight away asking the question that are you looking at stocks from a investment funnel versus the previous funnel, which was consumer-led. I'm guessing you are looking at investment-led themes picking up the mantle of growth, stock price performance as well over the next 12 months.
So I wouldn't say it's a 12-month perspective. I would say it's a more a 3-month perspective, and I would say it's a tactical rather than a. So for me, over a 10-year period, consumption in India remains the backbone of Indian markets. No one can deny that. But with a next 2-year point of view, I think that theme can correct itself. There can be in a 10-20-year bull market, you can have 2 years where those stocks don't do anything. And I think we have just entered a phase like that where some time correction, some price correction needs to happen over there. And in the meanwhile, there is another major theme with a lot of listed companies out there in that theme, which is emerging and which provides a better risk reward. So, I mean, it's not a 1-year kind of a call. If it actually does pan out, then it will be, the cycle usually lasts 3 to 5 years.
But you're not off financials, you do like banks.
Yes, within financials, I mean, I'm avoiding the NBFCs for the obvious reason. So, PSU banks don't have the capital. NBFCs don't have the liquidity right now. Banks have the liquidity as well as the growth capital. So, and they also have the product offering. So if in that kind of a scenario, I think the runway, so what NBFCs took advantage of for the last 3, 4, 5 years by capturing the market share, I think the banks have that runway as available to them with less competition to grab that. And also, I mean, of course, if my view is that private sector capex cycle is picking up, then these maybe the early movers will be the corporate lenders.
Okay, interesting. Would you be size agnostic here, or would you bet on the large ones?
No, I would be size agnostic. I think whoever is best positioned, who has the best liquidity, who has the best liability side, and who has the best reach, they should do well. I mean, there are smaller companies also out there that can do well, but I would more go with looking at the balance sheet and willingness and ability to grow.
But you've seen that willingness and ability to grow and a decent balance sheet in small size banks as well?
So I think, well, they are not, small size banks are not out of their asset quality problems as at yes, if I'm talking about regional private banks, they are still struggling a little bit with getting their asset quality in place. But they also do have the liquidity and the capital required. So maybe they will be, once the cycle becomes apparent and their asset quality problems are taken care of, they also provide a very good risk reward for sure. They are valued like a PSU bank at this point of time, even though they might be private companies. Without naming anyone, but they're all sub 1.2 kind of price to book. So that is where outsized return over 5 years can be made.
Interesting.
One more space within that is, again, it's a little offbeat, but small finance bank. They are not exactly corporate lenders. But again, that is a space where I think right now they are suffering because of the technical thing that has cropped up. Also, the fact that NBFC crisis would have led to some liquidity tightening and capital being an issue for them. Though on the ground it is not an issue, but the perception about them being a full-fledged bank or their ability to raise funds in the markets is still under question. So market will adjust to the fact once they get their liability side in place, then I think they will also have a good runway to grow. And their size, like you mentioned, their size is much smaller. So they'll have a much faster growth.
But this technicality is not a big overhang to your mind?
I think market is pricing that in. It is a issue, and market is pricing that in. The whether at this juncture market is saying it is for sure going to happen, and value is going to be destroyed. I think in case it doesn't happen for whatever reason, then actually there is a double upside to that. I think there's the couple of them that are listed are thinking about giving 60% of the bank's holding directly to the existing shareholders, and 40% being held by the listed subsidiary, listed holdco.
Holders. Holdcos, yeah.
If that is the case, then I think assuming a 50% discount to the holdco, you are still able to salvage 80% of the value.
The 60 plus 50% of the 40.
Yes, 60 plus 50% of the 40, 80% of the value you can salvage. And I think this is also a period where all the costs have been initially absorbed by these banks, while the growth is still up ahead of them. So there is a huge operating leverage that will pan out once the growth comes back. I think we could be a quarter or two away from that happening.
Interesting. Okay. These Diwali conversations with a lot of guests brought out 2 or 3 themes, Ravi, and which kind of starkly stood out. And a lot of people didn't bet so much on exporters as they bet on import substitutors. And specialty chemicals came out as a big theme out here, both on the export and the import substitution side. It's a space that has seen multiple years of growth already. Are you constructive here?
So I'm definitely constructive on the specialty chemical space, but I would just like to caution that specialty chemical is not a one sector. There are probably 50 subsectors under specialty chemical. You need to be sure of the chemical that you are investing in or the product that you are investing in, and the likely threat of a substitute or a neighboring country or where we are in that cycle, because a lot of the gains are price-led, not necessarily volume-led. So, and when those prices reverse, we have no idea about. So one needs to be diligent about what kind of companies you pick. Not everything is a specialty company, specialty chemical company. So that, having said that bit of caution, I think from a longer term point of view, there is a window of opportunity that is available to Indian companies thanks to the pollution issues in China, the trade war, and also combined with the fact that labor is becoming very expensive in China. So the manufacturing, and we have a base of manufacturers in India who can take advantage of that. So and the European and the American customers are looking for an alternative to China. So I think in that broad theme of import substitution and being the second supplier to after China to the developed world, yes, that theme is panning out, but you need to be careful about what stock you pick. It's not a black and white thing.
So, but within the chemical space, bulk chemicals, agrochemicals, specialty chemicals, you are selectively bullish.
Yes, of course. Yes, of course. So the strength of the company in that particular chemistry, their ability to produce at a competitive rate with China, or the ability to compete at a scale with China, all that will ensure the longevity and sustainability of the opportunity that they are able to encash.
Interesting. Okay. This Diwali, what nobody is almost spoken about are sin companies. Nobody's spoken about casino companies. Nobody's spoken about liquor companies. They just kind of fallen out of favor after being right out there the previous Diwali or the last quarter of the last calendar year. What are your thoughts here? Because I know you track some of these names very closely. What are your thoughts here?
No, I think in consumption space, definitely this is one space where there is some value as well as growth, which is not yet priced in. So I definitely like liquor companies. I think the largest one that is listed came out with some really good numbers, though it has had some patchy quarters in between. So ability to extrapolate that is missing at this point of time. But if I were to, these are the kind of companies that you want to buy and leave for your grandkids. I mean, no amount of disruption is going to hurt them. Only they can hurt themselves. See, having said that, of course, there is a regulatory risk always present on these companies because government are known to kill the bird that lays the golden egg. So that amount of risk is always there. But even if we believe that the sanity will prevail, then I think this is the biggest contributor to the exchequer at state level as well as the central level. So I think there are a few reasons why liquor companies, for example, are doing well and will probably continue to do well. The route to the market changes that have happened in various states, whether it is through the franchisee route, whether it is directly through the government, or whether it is through too many distributors, has led to a big expansion of the market, and it has been favorable for the industry. Then raw material prices are in favor. They have gotten some price increases in the last year, which they had not got for 4 years in a row. And the growth is coming back after a long time. So, and the competitive intensity has also decreased after the exit of the Indian promoter and the entry of the MNC. So the competitive intensity has actually reduced. So which is leading to growth as well as margin improvement in this space. So I think it is a disclaimer over here that we do own some of the companies, and I think this space is poised for very good growth over the next 2-3 year period.
Just one follow-up there. Would you bet on size out here? Because when I speak to Shekhar Ramamurthy of United Breweries or the USL guys or Radico Khaitan for that matter, reasonably large size company compared to some of these smaller ones. One, the market is giving premium valuations to the larger ones versus the smaller ones available dirt cheap, and the results delivery by the larger ones compared to the smaller ones is also showing chalk and cheese behavior. Is it safer to bet on the larger ones even if they are more expensive?
I would not distinguish it by size. I would say by brand. You should look at is there a pull, demand pull that particular product is creating, or is it just a commodity being sold? If there is a brand that is being created, then those are consumer companies in the right sense. While if it is just you are just selling ENA or you are selling country liquor or something like that, then you really don't have a brand pull and you are just beneficiary of the cycle at this point of time. So we would go with branded players. That's how I would say. And within that, there are only 2, 3, 4 companies at best. So it doesn't matter the size, but whichever is positioned with best brands in the best geographies. Okay. I think right now the north-based states are witnessing some real hyper growth. There is a lot of business that was off the books, which is coming back on the books. So that is leading to a huge surge. It's not. So for example, I'll just give you an anecdote that UP government last year had excise collection of about 16,000 crores from liquor. And this year they have budgeted 28,000 crores. So if a government is witnessing that kind of growth in excise collection, obviously that is coming from the manufacturer. So they are going to witness huge growth. And I think that growth is likely to continue for some amount of time because there's a monopoly distributor, and that monopoly has been broken, and those profits are being redistributed between the government, manufacturer, and the distributor.
Okay. I have one final question, Ravi, and various pockets actually. I don't know if you would want to talk about some on your own, but I wanted to check about autos because I started off saying that it's been a different somewhat in that sense because select banks have not been there. Stocks like Maruti have been absent, and it's amazing what the last 2 months or 2.5 months of maybe higher insurance costs, maybe higher rates, maybe higher fuel prices have done to perceived auto demand and therefore the pullback in stock prices. What do you do within autos or within auto ancillaries which also have this export element attached to them? How are you approaching this space, if at all?
No, I'm avoiding autos at this point of time, especially the passenger vehicles, because I believe a lot of the growth in the last few years was fueled by the NBFC lending. And I mean, besides that, one risk that you forgot to mention is the disruption of electric vehicle coming
Some
at that
time away, right? No?
some time away, but see, market are forward looking, and there is something that is at this point we feel might be 10 years away. Market might start factoring in today. So we are witnessing this disruption in the media space very clear and present today. I mean, one of the large broadcasters is thinking about selling out 50%. I think that's a submission of the fact that the tech is hitting them. I mean, it could be also, they might have other reasons, the balance sheet issues in some of the group companies. But at the same time, the disruption risk is real. We can argue on the timeline. So I think when markets have trouble understanding what terminal value to give, the valuations start tapering off. Plus, add to the fact that this festive season has not been that great. So, I mean, I don't see a reason why one should be rushing back into this again.
Ancillaries?
Ancillary is not, again, I mean, from the fact that they are manufacturers, some of them are exporters, and there is a probability of being an outsourcing hub. Yes, I would go with those kind of ancillaries. But if there is an over-dependence on passenger vehicles in India, then I would be careful. CV cycle is still continuing, so maybe CV-focused auto anchs would still be okay.
Okay, a handful of names, and one name that gets spoken about quite regularly, to be honest. Don't even need to name it. My final question, Ravi, and that's on pure play exporters. And there are product companies within the IT space, there are pure service providers, and there's a mix out there too. And then there's a size differentiation. Somehow, this cycle, the market has rewarded the mid-sized companies in a very emphatic fashion. Do you think that merry run is over or a bit of a pause here? Or do you reckon that the market will believe that if you're a cash generating company growing 13, 14, 15%, there's no harm in giving you a 20p multiple?
Okay, so I think IT is one space and pharma is also another one that we'll speak about. But just to speak on IT, see, I don't think India's role, India is very, very entrenched in the global supply chain in IT. It's not going to change. The overall macro, India increasing its market share in the IT outsourcing space, in particularly, and within that service, is a secular trend that's going to pan out. Maybe a year and a half back, these stocks were factoring in a possibility of a 7-8% growth. And the moment that 7-8% turned out to be 10% kind of a thing, there is a re-rating that has happened. So that one round of re-rating, you are right, could have, could be done with. And the mid caps actually whoever displayed 15 to 20% kind of growth got rewarded disproportionately. So to that extent, that reversion of the mean trade is done. Now, maybe after some consolidation, once the market gets its confidence back that this kind of a trajectory can sustain over a period of time, I don't see that risk that these companies are going to go down under. Okay, and I think there is a lot of technological changes that are happening, and the relevance of Indian IT company, they have to keep themselves updated, be on the edge of the technology. So if they manage to do that, then I think their opportunity is there for them to take. So when you put an exporter growing at 15% compared to a consumer company growing maybe 20% or 25% but valued at 40%, I think IT companies are okay. Maybe after a round of correction consolidation, they'll still go back up. It is not all doomsday.
Interesting. One can't not have a conversation with Ravi Dharamshi and not talk about pharma.
Yeah.
So let's. That's the final question, really. I mean, what do you see here? Because the last few days have shown some chinks in the armor, if I may. The delivery by the largest company, despite promises made over several quarters about the next quarter looking good, not quite out there. Some of the other companies have had issues, and this is despite almost everybody saying that pricing pressure in the US is now out. How do you approach this space now?
So I'll tell you what, we have to accept one fact, that the attractiveness of US markets has reduced, and probably has reduced for good in the oral generic space. Now, there are still pockets of profitability, whether it is inhaler, whether it is biosimilar, whether it is specialty. So those profit pools are difficult to capture, require far higher investment and much in advance. So there is and these generic companies have gained in size over the last few years. All of them are quoting like 30,000 to 50,000 crore kind of market cap. So they are not small. But having said that, they do invest a lot in R&D. There is a transition phase. For them to make the next move, they have to diversify away from US and diversify away from oral solids into specialty devices and many other things where the profit pool is still available for grabs. So in that kind of a scenario, I think valuation wise, I think we have corrected substantially. But I think now companies that used to grow 25% plus have now come down to the profit growth being 10% and 12%. They are running hard to grow by 10% and 12% or stay in the same place. So that is why there has been a derating in this sector. And until and unless market sees that 10-12% going back to 15 and 20%, I don't think valuations are going to change dramatically. And that kind of a growth can only come from if they have some special product or if they have managed to crack a new geography. Over there, I think one point which I think is relatively new to Indian market is that China is emerging as an opportunity. China selling pharma to China is going to emerge as an opportunity over the next 5-7 years. Just an anecdote, that a company that we own told us that they took 7 years to get their first product registered in China. The second approval for them just came through, it took them 18 months. China is very keen on having India as a second source supplier of generic. They want to bring their healthcare costs down. So I think this is going to be a very interesting opportunity, and maybe to some extent we'll be able to compensate for the lack of growth or lack of profits in the US markets.
Well, one certainly hopes so, but that's an interesting anecdote.
But everything said and done, we are still in a transition phase at this point.
Yeah, let's see how long it lasts. But we hope that the transition phase of the market doesn't last too long. But Ravi, it was a pleasure talking to you today. Thank you so much for taking the time and speaking to us on Alpha Moguls.
Thank you.
And viewers, thanks for tuning in to yet another episode of Alpha Moguls.